Okay, folks, welcome to the Art of TradeStation. I'm David Russell. We're going to start in just a few seconds. Okay, everyone. Welcome to the Art of TradeStation's fundamental analysis on the TradeStation platform. I'm David Russell. It's great to be with everyone. I'm VP of Market Intelligence here at TradeStation, and wanted to first, I'm going to share a few things in the chat. We're going to use chat in the Zoom for all of our communication. If you have questions and everything else, please send an actual message there, and that's where I will be answering questions. All right, let me first just get started with a few disclosures. This content is for educational and informational purposes only. Any symbols, financial instruments, or trading strategies discussed are for demonstrational purposes only and are not research or recommendations. TradeStation companies do not provide legal, tax, or investment advice. Past performance, whether actual or indicated by historical tests of strategy, has no guarantee of future performance or success. There's a possibility that you may sustain a loss equal or greater to your entire investment, regardless of which asset class you trade, equities, options, futures, or cryptocurrencies. Therefore, you should not invest or risk money you cannot afford to lose. Online trading is not suitable for everyone. Visit tradestation.com/important information for a copy of the document characteristics and risks of standardized options before trading any asset class. Customers should read the relevant risk disclosure statements on our important disclosures and information page. System access and trade placement and execution may be delayed or fail due to market volatility and volume, quote delays, system and software errors, internet traffic outages, and other factors. TradeStation Securities Inc., TradeStation Crypto Inc., and TradeStation Technologies Inc. are each wholly owned subsidiaries of TradeStation Group Inc., all operating and providing products and services under the TradeStation brand and trademark. Duke Trade Inc. is also a wholly owned subsidiary of TradeStation Group Inc., operating under its own brand and trademarks. TradeStation Crypto Inc. offers to self-directed investors and traders cryptocurrency broker services. It is neither licensed with the SEC or the CFTC, nor is it a member of NFA. When applying for purchasing accounts, subscriptions, products, services, it's important that you know which company you will be dealing with. Please visit tradestation.com/important information for further information explaining what this means. Any examples or illustrations provided are hypothetical in nature and do not reflect results. Do not reflect results actually achieved or do not account for fees, expenses, or other important considerations. These types of examples provided to illustrate mathematical principles that are not meant to predict or project the performance of a specific investment or investment strategy. Accordingly, this information should not be relied upon when making an investment decision. Okay, great to be with everyone. Before we get started, I wanted to just briefly show you guys some of the things that I do here at TradeStation. If you actually go to the TradeStation website, we have, if you go to research and insights, here's the blog I run. I also do Trading View Ideas. It's an outside charting service that has a link to TradeStation. Some of these things are of interest. For example, I would in particular point out the recent chart analysis I did of the NASDAQ 100 and also of Amazon. Both of these kind of saw some interesting patterns developing. Have some proprietary indicators that I share from time to time, including in Masterclass, which is a great educational resource we offer that I do along with Jesus, mostly run by Jesus Nava, but I am involved as well. There's a link to that in the chat that I shared already. I did want to mention just very briefly that to me, what's very interesting about the S&P here is that it is possible, and we wrote about this on Monday. First of all, we noticed last week, this is the interest rate expectations, this sharp slowing of interest rate expectations. If you look other places on Market Insights, we've been talking about the diminishing of the inflationary narrative for the last month or so, starting with the collapse of lumber prices. So there's a lot of interesting things sort of happening here. The other thing was that really stood out to me when you look at the market here is that we held a low from December of 2020. Right after we got that vaccine news, November of 2020, the market jumped to a level. It then came down and held that level in December. And then we held that level again in mid-June, which is on this chart. And then we made what is potentially a higher low on the monthly candle from March 2021. this downturn that we've seen this calendar year has been lower lows, lower lows, lower lows, and now it appears we have a higher low. So I think there's an important thing to recognize. We do not yet have a higher high, but now we might want to be looking for this peak here that we're pretty close to. But I wanted to just point out these are the forces I kind of see coming together. Very, very quickly, I'll just notice there's several other stories here. Gasoline futures are dropping. There's this article back, the last CPE inflation report on June 30th, lower than expected. We also see signs of the employment market cooling down a little. We had some other data that is kind of consistent with what the Fed wants to see. We saw jobless claims higher than expected the last 2 weeks. We saw the ISM manufacturing report weaker than expected, which I think was last week, right before the holiday weekend. And then we also now have, of course, Goldman Sachs coming out, lowering their GDP forecast. Thanks a lot. But still, these pieces still coming together for a market freaking out about inflation, collapse of oil prices, collapse of inflationary commodities like lumber, copper, other metals, and the slowing of the economic situation. All these things coming together, entering a new half before earnings season, Amazon Prime Day next week. All these pieces coming together for a potentially significant change of character of this market, going from a value inflationary market potentially back to a growth market. And we have growth stocks that are down significantly. And I think we should, everything I'm looking at in this webinar, I want to kind of put through that lens, because when we're talking about fundamentals and we're talking about, things like earnings growth and all that stuff, all of those things have a potentially different meaning in an environment where, the Fed has, the most of that is now potentially priced in. If this narrative I'm describing is correct, I think we just need to bear that in mind. So I wanted to point out that context. And the other last thing I'll throw in is that there's various sentiment indexes I look at: American Association of Individual Investors, the NAIIM, which is an Institute of Active Managers, the CNN Fear and Greed Index. All of them are still skewed heavily toward a bearish situation here in terms of overall pessimism, suggesting the market remains underowned. So I wanted to put those pieces together for you guys very quickly. And now let's get on with this webinar. What is fundamental analysis? That's the first thing we're going to look at. And fundamental analysis, a few ways to define it, but the way I want to look at it is fundamental analysis considers a company's business performance and valuation. It mainly focuses on financial ratios and multiples. Fundamental analysis differs from technical analysis, which is based on price action, and macro analysis based on broader market conditions. Very quickly, macro analysis, earlier this year, oil was jumping. People just buy energy stocks. It doesn't exactly matter who has better earnings or everything else. There's just a rotation from point A to point, from tech to energy. That is a macro sort of thing. Technical analysis, when we look at the technicals of individual stocks. Fundamentals, when we look at the things that actually pertain to the company's business. So we have our common metrics like the price earnings ratio, PE ratio, most of us know that. Price to sales, which I find in some ways a really interesting one, because it's so relevant for technology stocks, as I'm going to get into. Earnings can be very confusing for technology stocks. Revenue growth, that's just a simple measure of how much you're growing, also important for growth. And of course, at the same time, we have to think about that macro situation. Oil stocks probably have amazing revenue growth now, but then if oil turns around, then it doesn't matter how well they do their business, boom, they all get hammered. So that was a macro rotation. And now the question is, if we have this shift back to a sort of fundamental growth focus, things like revenue growth, real revenue growth, are going to matter more than just an exogenous force like a rally in earning in oil price. Dividend yield is also useful. It basically shows how much a company's dividend is as a percentage of the stock price. It tends to follow bond yields, which means when yields move higher, stocks with higher dividends tend to lag. There's various reasons for that as well, which I'll get into. Some other ones I actually think can be more valuable are something like book value growth. Now, one of the reasons I say that, as I'm going to get into it with earnings, is that with a lot of companies, as some of you guys, probably accountants, you probably know that when a company has earnings, there's a lot of things in there like depreciation and stuff, which in many ways can have, they can really distort the meaning of earnings. The thing is, when you have something like book value growth, if a company's book value or their equity is growing over time, You can kind of play with earnings numbers a little bit with accrual accounting. You can move things around and make things look good or bad. You can do it a couple of quarters, but at companies with consistently growing book value, that is an interesting thing you want to look for. And the same thing when it's consistently diminishing. Cash flow growth excludes those sort of things I said, like depreciation, which can be, a really interesting sort of metric for, for secular growth stocks. In fact, one thing I'll just mention off the bat, Salesforce.com, I think this was in a quarter. It might have been the full year. I'm pretty sure it was in the quarter. I didn't write it down. But they had $3.5 billion of free cash flow and $1 billion of net income. And the reason is that they have acquired all these companies. You go out, you acquire a company, you now, if you pay over you pay a premium, you now have this huge thing that you have to account for as an asset, basically on your books. So the thing is that they pay more for assets that are out there. And what that does is that the assets they pay for are often carried at the value of what it costs to actually create them. So if a company goes out like Microsoft and it actually builds value over time, the cost of creating those assets is much lower than what they actually see. So as a result, you end up with these companies that can trade at very high sort of book values and things like that. And it can be really confusing. If you focus just on the free cash flow growth, it will show you the companies that are actually doing better in terms of earnings. So it can get really complicated when you look into it. But the most important thing is to just realize that for different companies, different sort of things can matter. All right, let's look at price to book, one of the most kind of useful things. When we're in a time when people are talking about growth versus value, this can really matter. And in particular, it matters when we're in a rotation into value stocks. So what I noticed when we were, back when you first saw that vaccine news come out in like late 2020, and other times people just bought the stocks that had the lowest, price to book. And that off the bat, that was just the kind of hunt for value overall. Now we're in a period of time when it's possible if the kind of scenario I outlined before plays out, that could very much diminish. So price to book is a valuation that allows you to quickly see and look at a stock and know, is it a growth stock or is it a value stock? And once you recognize that, the kind of market we're in, it can help you very quickly to just kind of screen out the sort of things that you want. Now, enterprise value to market cap is something I created, and I'm going to share this. Let me actually show you the workspace very quickly. If you actually open, I meant to actually show you how to use a zip file. I ran right past that. All right, you open up the zip file that is in the message I shared earlier, and you're going to see three things. You're going to basically see this. These are the slides here that I'm actually going through as a PDF. This is an easy language indicator library. It's going to have a bunch of indicators in it. So you want to double click on this. And when you do that, it's going to bring up this dialog box, and you can import all these indicators into TradeStation. And then once you have that working, I'm going to cancel it because I already have them. You're basically going to want to open up the actual workspace, which is this one with the blue logo. And you're going to get basically this, which has a series of custom indicators that I created for doing fundamental analysis that you can open. And we're going to get to those. But just so you know, a lot of these things I'm going through are in this workspace. So I wanted to get back really quickly to the idea of enterprise value versus market cap. There's a lot of things like debt to equity and a lot of other sort of measures that they work for some industries and not for others. The thing I like about enterprise value to market cap is that it can be the most universal measure of how much leverage a company has. And what it basically is enterprise value is the market cap plus the debt of a company minus the cash. So it's kind of like, imagine you have a $1 million house and you put down 20%, put down 200,000, you buy the house. The enterprise value is $1 million. Your equity is only the 200,000. It's important because you could put down 500,000 or a whole million. and the enterprise value of the house is the same, but the equity is radically different. So the thing is, if you buy a company and it has a similar structure, the actual thing you're getting is the enterprise itself. And then the question is, how is it capitalized? So it's important to understand this, because if someone goes and buys that house, they're going to pay $1 million for it. It doesn't matter how they finance it. What matters is that's the price of the house. And the true value, because this was created for private equity firms, essentially, the true value of a company is its enterprise value. And this approximates much more the actual takeover cost of a company. So it's important to understand something like enterprise value. So I created a ratio using the tools in TradeStation as my own custom indicator of enterprise value by market cap. And the bigger the number is, the more leveraged the company is. And we're going to look at that in a second. Okay. So let's take a look at this, the workspace that I have here. These are the indicators. And before we go much further, that I actually want to jump over and show you very quickly some of the things that are built into TradeStation that you can do yourself just without the workspace I'm giving you. So if we go now to apps, RadarScreen, this is the tool that I'm working with. It looks like the little circle. Now, just so you realize, on yours, it's probably not on the top left here. It's probably somewhere over here. I moved it. You can move these around, so I moved it. Now, let's just bring in, we go to data. Let's just bring in the entire S&P 500. All right, I'm going to select all and change it to daily. It's always simpler for me. Time frame. Okay, so I'm going to add a bunch of custom indicators. These are these are not custom. These are the standard, some of the standard fundamental indicators that are built into TradeStation that are available to all you guys without the tool, without the zip file I just shared. So you go to studies, add study, and then this is for some reason doing show me. So you want to make sure it says indicator. Okay. There we go. All right. Now I want to do a few. First one is balance sheet. Let me do like balance sheet MRQ. I can add that. The next one, that means most recent quarter. The next one I want to show is cash flow. Oops, wait. There's also, you can just hit on like see cash flow. The next one is dividends. So these are a series of things that are already built in for you guys. Dividends, financial strength, income statement, trailing 12 months, and net income growth. Oops. I have a lot of indicators that I've kind of created here. You can add all these now. It's going to take a second to bring them all in. So it's just some simple things you can kind of do yourself. And this data is all available to you. So what I essentially did was I kind of hacked into the code for this to create something for you guys, which is my custom workspace here. The thing about these that I find, not always super convenient is a lot of that you only want one column, and something like cash per share or something like that, it's nice to know how much cash company has per share. But the problem is then you have the share price being different. So what I did for a lot of these things was I turned these things into ratios and stuff using easy language, which I'm going to show you next. Okay. So for this, custom indicators are written in TradeStation's easy language system, which is it's a coding language. Let me tell you, I'm not a developer. A lot of us in the modern world, we have to do things like hack little bits of code here and there. We need to get a spreadsheet to work or something else. So I think everyone has a small amount of skill. A lot of people now have a little bit of skill of digging in and kind of, borrowing little bits of code and adapting it and making it work. And that's really all you need to make something like this work. You can use some really sophisticated coding in easy language, or you can make some really simple stuff. And that's what I wanted to show you here. So, this is the key piece of code. It's called fund value, and then the code goes there. You need the zero and error code. And what this does is this queries a server on TradeStation. It needs this to handle, like if there's no value for whatever reason, it's going to return some kind of error. And this requires that you have this to handle the error. Otherwise, it won't work. So basically, there's this command, and then the actual little codes you're going to put in are right here. So I'm going to actually go to this very quickly and show you just what this looks like. It's on one of our help pages. It's just a series of things like this. So the codes you're going to use to create custom studies, you can look down this table. It's quite extensive. And then you basically put this code into this spot here. Oops. Into this. And it's all right here in the zip in the PDF as well. So basically that's what I did for most of these. So let's go back to my custom workspace now. And we have the S&P 500. So if you go to something like EPS growth and you right click on it and you go to studies, edit easy language for EPS growth, you can actually see the code that it uses. And I think it's like 2 lines of code. I see a question. I presume you'll be sharing the deck later. It is available in the zip file that Manolo shared again. If you see, there's a zip file, the second one, and it is in there. So this is all it is. If you look at this, you can see I'm using the plot 1 basically means output or like print. It can output multiple things. It can have multiple plots. So for example, this one has 2 plots. And it's all just one simple line. You just need this thing up here that defines the variable first. Now, if you want to learn more about easy language, you might want to check out our masterclass, which is also in the zip in the message that I sent. And that's pretty much it. All the other stuff here is really elementary in terms of any coding you need to do. So I wanted to just show you guys how this works. I mean, once you really start digging into all the things you can do with TradeStation, it can really be pretty mind-blowing. And the great thing is you can create revenue, you can create ratios and all sorts of other stuff, which is essentially what my enterprise value to market cap and things like that. And it allows you to just quickly do this kind of analysis. So let's go now to so like I said, enterprise value to market cap is a universal measure of debt. It should, quote unquote, should be high for banks and utilities. Let's go over to the workspace now and see. Here it is, EV to market cap. And if we look at them, NTRS is Northern Trust, which is a bank. Also, I want to point out, I did some other things with this workspace. And I think this just shows you the kind of stuff you can do with TradeStation and some of the cool stuff that it allows you to combine. In this case, I am combining multiple indicators. I am combining, these are price changes. So this is going to show you the performance in the last month. You can rank them and see, okay, in the S&P 500, the Royal Caribbean is the worst performer in the last month. Let's actually look at what its enterprise and market cap is actually a pretty high level as well. Shows you they got a lot of debt. You can kind of look down, you can see these numbers working right here in real time, but we're combining technical information with fundamental, and TradeStation allows you to do that. And honestly, a lot of screeners don't let you combine technical with fundamentals the way TradeStation does. And it can be really powerful because I'll often just look at companies, and I was doing this webinar a year and a half ago, almost the same thing, except it was the opposite. We were talking about the value stocks. And I was saying, let's look for stocks that are down a lot and have a lot of debt and are cyclical and have the worst earnings or something like that, because those are the companies that had gotten hammered in 2020 that were now coming back. And now it's, it just changes, obviously. But the thing is that these principles don't change, just the way we apply them do. The nice thing also about this is that you can then rank them and organize them by which sector and industry they're in, which is very important because one of the things about financial ratios is that they tend to be similar for companies in the same industry. So if we look here at certain kinds of technology companies, like, you look at something like software, you're probably going to see that they have similar, in many cases, a lot of these companies are going to have similar, price to sales in a lot of cases. They might have price to sales kind of depending on where they stand. A lot of these were, now they've pulled back so much, but a lot of these companies would traditionally trade for 15 times revenue. You're going to see they trade at similar kind of price to free cash flow, price to earnings. In many of these cases are very high. Then if we look at energy stocks, for example, a lot of those are going to be, let's look at energy like by sector. You know, a lot of these are going to look at their price to earnings are going to be much lower. So you see that the ratios correspond based on the industry. It's very important when you're looking at financial ratios like price to earnings or price to book or any of these other things that you compare apples to apples. There's reasons that I'm not going to get into why different sectors trade at different valuations, and different valuations matter for different sectors. But simply knowing it and being able to quickly sort them, you don't really need to know exactly why. You just need to know, okay, these things are like, we're comparing apples to apples. We're not comparing, pigs to fish or something. We're actually comparing, two things that are similar to each other. And that's what's most valuable about this, being able to sort things in this way. All right, this is slide 10 I'm on. So companies with low values for low PE ratios are not always value plays. In fact, an example I want to point out for that, which is very interesting to me right now, which I've been looking at, are the housing stocks. These companies, now some of these companies historically had like kind of, their trailing earnings might not be profitable, which is why they have zero for these values. But if you look, you actually can see here that you have a lot of home builders and stuff like Lennar, and some of these other companies, Pulte Home, down here at this value level. It's also interesting that we have something that jumps out to me like a sore thumb is Moderna. Pretty interesting. And I want to point out that we actually were writing a trading view idea about this back here. We had seen some of these patterns of this stock coming off the lows. Pretty interesting. So you can make of it what you will, but it's just kind of interesting to look at some of these things like valuations and to see the similarities between companies in their own industries, including here, a lot of, I didn't notice this before, but now we're starting to see a bunch of retailers like PVH and what was the other one I saw here? Bath and Body Works, for example, trade at relatively low single digit, earnings, things like that. So some of these are the sort of things that, allow you to easily compare and kind of do some analysis evaluation. All right, earnings growth is a broad measure of profit growth. It can be used inversely before or after recessions. Beware of changes in guidance or outlook because earnings growth is a lagging indicator. Honestly, I have gotten to be very wary of earnings growth as a useful thing. What I have found with, over 20 years of doing this now is that usually by the time the earnings growth is reported and in the history, it is usually well priced in because if companies have good news, they are going to broadcast it in various ways. That's why in many ways, I am much more of a believer in technical analysis and in kind of a macro analysis, figuring out which sectors are doing well, because the market has gotten pretty good at anticipating where the growth is going to be. But anyway, this is one of the values here that is available to you guys if you want to look at something like earnings growth. Again, one of the problems with it, though, is you can have some funny things. If you look at some of these companies like AIG, I'm not sure exactly what their story is, but some of these companies, maybe they had a very low number a year ago for whatever reason, and then they suddenly go back to a more normal number. It can create a strange impact on the base effect. So I am not as much of a fan of earnings growth, but I wanted to include it because it is such a basic sort of thing. Price to sales can be useful for software and IT services and healthcare. It's less useful for industrials and consumer stocks where margins can be more important. I really like price to sales when you're comparing, in particular, pharmaceutical stocks, when you're comparing medical devices, when you're comparing software stocks. Those are the companies where price to sales are the most meaningful. Okay. Another thing I'll mention about the last one is that when you had a lot of companies coming out of COVID, a lot of companies went from, they had like minus 90% earnings growth or 90% revenue growth, like some of the airlines and stuff. And now as they go back, you're still seeing just in another quarter or two, it'll probably be pretty much gone, but you're still seeing a few weird numbers of companies with really dramatic growth as things go back to normal. So just realize that we still have a little bit of that weirdness with the impact of the shutdowns. All right, so there's a model out there, and I wrote about this a lot, and it was very accurate about what was happening, and a lot of people know this, but the impact of interest rates on valuations. So we talk about price to earnings ratio. High readings mean the stock has more price for its earnings. This is kind of common sense, but there's another way to think about it, which is that the earnings by price is the yield. Now, no one really talks about this, but it's in a lot of models. And basically, if you have a high earnings yield, it means the stock has a lower P ratio, which isn't a surprise because all you're doing is flipping the fraction upside down. But there's a model that actually a lot of strategists use, which is they simply look at the the earnings yield of the S&P 500 against something like the 10-year Treasury. And I was doing a little bit of calculations before this webinar, looking at the current numbers. So the idea is that the higher the earnings yield, the cheaper, quote unquote, the stock market is. And if the interest rates go up, the stock market has to compete with those yields of the S&P. So as interest rates go up, the earnings yield has to go up. And if the earnings yield goes up, the price to earnings ratio has to go down. So if you go back a year ago, and this is according to Standard & Poor's, if you go back to June of 2021, the PE ratio of the S&P was 28.6 times, which is a 3.5% earnings yield, which is pretty high historically. It is now 21.5, which is an earnings yield of 4.65. So it has come down considerably. In that time, the 10-year Treasury yield has essentially doubled from 1.6 to 3%. So these were things that were that could be anticipated and that we talked about and wrote about, and a lot of other people did at the time. But it's important to understand this relationship because this really does it's like a deep structural sort of part of the market's valuation and where investors want to be. So it also means that if we've seen something of a peak in the 10-year Treasury or stabilization for a period of time, we could be at a time here where those earnings yields could actually start coming down, which means the P part goes up, which means prices go higher in things like NASDAQ and the growth stocks. So I want to just emphasize this. It's important, I think, to really remember this because this is a really key part overall of market valuations. That was slide 12. Slide 13. So secular declining stocks. When you look at a company, one of the companies that always interested me was, honestly, right when I started doing this back in 2000, when I was at Bloomberg, Eastman Kodak was actually still in the Dow Jones. It's pretty amazing when you think about it. Back in 2007, 2006, I remember Gannett was still in the S&P 500, New York Times, these legacy media companies that literally still were newspaper. I mean, they were newspaper companies. They were not digital. They were still traditional, wood pulp. And, these stocks just went in total declines, total downtrends. And there were other media companies, some of these companies that went bankrupt. But the key thing is that when a company is in a secular decline, when it's something like I just described, that their underlying technology is losing value, what's going to happen is the stock price is going to go down and the debt is going to remain the same. So what you're going to start to see is you're going to start to see the debt eating the market cap. And as that happens, these companies can become very solid long-term shorts. And this happened with General Electric as well, which used to be a AAA credit. And I mean, now it's been, but if you look at when General Electric started its decline, I mean, basically wait, this is not long enough. This is the one I'm talking about here. And I think they had a stock split along the way. But basically, you could, as this happened, the enterprise value to market cap, the debt remained the same, and the capital, the the market cap simply shrank and went away. So it's important, I think, to realize that if you can understand and identify a company that's in a secular decline, these sort of declines really happen. And what matter is these are not value. These are basically companies that are getting eaten by their debt. So it's kind of like if you have the $1 million house and you have that 20% money down and the market and the house goes down 10%, you know, your equity just shrank a lot. Even if you have like 50% equity, if the house goes down 10%, you lose more than 10% because of the fact that it has that debt. And the more it goes down, the more you lose because your debt remains the same and the actual valuation of the enterprise goes down. So one of the things I wanted to point out was this is a common sort of thing that people should be aware of on the short side and on the long side. Now, we haven't seen a lot of these in a while. Honestly, most of them have already happened. From what I can tell, most of the big decliners we've seen in the last couple of years have been overvalued technology stocks, but Kraft did this as well back in like 2000, the last couple of years. These trends have not been as common, but they can happen. And one of the ways you recognize them is when you have a legacy company that they thought that the good times would always be there. So they ran up a certain level of debt. And then when the good times faded, what happens, like I said, is that the overall valuation of their business shrinks, and then that debt just kills the valuation. So it's important to recognize this sort of trend because it's one of the strongest things I've seen. And on top of that, it can keep you away from buying garbage value stocks that you think are value, but in reality are just headed to, something in the single digits or lower. And in some ways, the cruise ships and the airlines might be in this category right now. The question is, coming out of COVID, combination of people traveling less over the long term potentially, and the labor costs and other issues. The question is, do these companies really have, is the enterprise really worth as much as people would think? And then with that debt on top of them, they have that potential to get sucked lower. So I wanted to point this out because I think this is an important thing. So those are secular declining stocks. Technology stocks, on the other hand, and these are just trends by sector, technology stocks have higher price to book values because the value of the balance sheet of how the balance sheet shows the value of intellectual property. So for example, like I said, how much does it cost Microsoft to write a piece of software? Not that much. So that sort of thing, essentially they write software and that doesn't show up as any real value on their balance sheet. They have an asset and they don't even, what do they even say it's worth? If you go and buy a building, that you carry that on your balance sheet. But if you write a piece of software, essentially it's just an asset you have. So it doesn't really show up. And as a result, those companies trade at a massive premium to their declared book value because the value of that software doesn't really show up on the balance sheet. The same way the value of an oil field or a building or a factory shows up because those are really accounted for. The other thing is if two technology stocks merge and like Salesforce.com buys Tableau software and then they can go and sell that product through, they are going to make more money based on doing that. And investors will pay more for that business. And then you're basically going to see that the price to book gets massively inflated over the cost of what they paid for it. And those are two of the big things to understand about technology companies. They might trade at this huge price to book because the book value doesn't really mean that much for a tech stock. But for a bank, it means everything. So it's important just to realize that these ratios matter structurally based on the business. Companies trading for less than book value tend to be either highly cyclical and or distressed. So another sector that tends to trade for book value are the financials. And this is just kind of important to recognize that, a lot of these stocks trade for, less than book value, which means that in an environment where when the economy accelerates and in many cases here, the question is going to be the yield curve. But if we swing back toward interest rates going higher, yield curve steepening, these are some of the stocks where the money could rotate. And screening for these companies based on, like a life insurance company, when the curve steepens, they make a lot of money because they invest the premiums coming in, they invest them in longer term assets. And when those rates go higher, they can make more money. So the thing is that this can be very useful at a time when the rotation goes back to value, looking for stocks that are trading at a low price to book. And banks are obviously cyclical. Okay. The other thing is that when companies are distressed, very often when you're coming out of when you're coming out of a recessionary environment, those kind of cyclical junky companies that were trading at a kind of bankruptcy value or a risk of bankruptcy, as they swing back to being alive, those can be some of the biggest rebound kind of opportunities as well. So it'll be interesting to kind of, I mean, at this point in the cycle, I'm not sure. I mean, some of these cyclical stocks that have gotten hammered lower, I'm not sure about some of them. When I look at it, I'm not, it seems difficult to really imagine the yield curve steepening a lot over the long term here, because the situation we have, I mean, unless you really think energy is going to, oil's going to go to 200 or something, we're probably at a point now where, we could be settling back into more of the flat curve environment and, favoring the growth stocks. But if you see that we're in a spot where we're going to have this explosive sort of growth, cyclically, like we had back in late 2020, early 2021, then those are the companies where people are going to pivot to, the companies with low price to book values. And the reason, like I said, is because they're both cyclical and they're often going to be distressed, kind of like junk investment grade, non-investment grade companies. All right. So now I'm going to go through some stuff with Scanner. So let me jump over now back to my TradeStation platform. I actually have this other workspace that I created, and I just did this because Scanner is hard to see. So I made it in bigger font. So we're going to create 3 scans here. We're going to scan for growth stocks, value stocks, and another little kind of bonus that I wanted to share with you guys is I created a tool that allows you to find recent IPOs. Now, a lot of these stocks that went public in the last 18 to 24 months are down like 70 or 80%. And if my suspicion is somewhat correct and we see a rotation back toward value stocks, the kind of Cathie Wood stocks, those kind of names, some of those companies that are down significantly could be, areas where, people kind of get interested. So I'm going to show you how to find some of those too. I included a special tool, again, insanely simple coding that I did to do it. Hopefully it encourages some of you guys to roll up your sleeves and do a little coding, because it is a lot of fun. All right, so first we're going to look for growth stocks. These are the steps we're going to take in Scanner. I'm not able to share a Scanner with you. It cannot be copied the same way Workspace can. So just keep this yourself, slide 14, and I'm going to jump over and show you how to do it. I'm going to go to Create Scan. I'm going to call this one, actually, I already made it, but I'm going to just, I'm going to erase it and do it over again. I meant to erase it. Just hit delete. All right. I have too many scans existing. It's hard for me to keep them all straight. So I'm just going to call it 2020-07-07, and then I'm going to call it growth stocks. You have to name it first. Go to all stocks. I have a default setup, which I'm going to remove, but if you set up criteria and set it as default, you can do it down here. You might want to do it for a market cap of like $1 billion or something like that, but I'm going to show you guys how to build the whole thing doing this. So the first thing I'm going to do is I'm going to look for capitalization. Market cap greater than 1,000, which is $1 billion. Next, we're going to go to profitability. Revenues, revenue growth rate 5-year, greater than, say, 30. Remember, these are growth stocks. We want companies that have that longer term growth rate. And another thing, got to be careful with revenue growth, because you might have a biotech that went from $1 million of revenue on a royalty payment or a milestone payment to like 10 million, and it looks huge percentage wise. So we want to go to TTM revenues TTM, which means trailing 12 months. Nice thing about that is it's always going to have the last 4 quarters be careful of some of these other valuations, because some of these, like say, you could be in, the fourth quarter, you could be in like November of this year. And if you look for some of these like year-over-year revenue growth, it's going to be looking like, if I did it right now, it's going to look at revenue growth of 2021 against 2020. So I always use TTM, just realize that, because that way it'll just look most recent quarter, which would now probably still be the March quarter. Anyway, revenue TTM greater than, we're going to say $1 billion, because we want companies that actually have, some kind of size. And then you could set it at 500 million too for some things, especially if you're looking at smaller biotechs, which is starting to get interesting here. Some of the smaller software companies are still under $1 billion. Now, another little trick. This is one I've created, and I really want to, I'm happy with myself. It's a little hack that can be great for scanner. You go to, if you go to select criteria to indicator, now this is going to use the same indicators that are available in RadarScreen, and in many of them, they're also available in the chart. So we're going to go down here to industry. And what I like about this is this allows you to basically sort by industry the same way that we're doing in RadarScreen. So does not equal, quote, quote. That basically means is not null, right? And it's they all have an industry. So it's just going to return the value of the industry. And here we go, what it is. So if we look here, these are coming to 30-year history of revenue of 30% growing revenue in the last 5 years. Tesla, Meta are right at the top of market cap. Nvidia, Alibaba, AMD, just what we would expect to see. ServiceNow, some of the stuff like this. So that's just a useful thing right here. You can also, I'm not going to do this right now, but there's another, two other things to consider are earnings per share. You might want to make sure that the earnings is just a positive number. Sometimes you might get some data anomalies, and you might also want to have book value growth, 5-year share book value growth per share over the 5-year period greater than 30. Now, this is one of the custom indicators. So this is going to be in the custom indicators. If you've loaded the ELD that I gave you guys, it's going to be same thing under indicators and not under the original buckets. So let's create the next one, and I'll show you what I mean. Let's call this one 2022-0707 value stocks. All stocks. Now, you can also include or exclude indexes and things like that if you dig around in some of these settings, which can be pretty useful. Sometimes it's interesting to exclude S&P companies. You might be looking for those companies that are becoming popular. There was a time when companies like Roku, Shopify, Square, they're still not in the S&P. And they were, really outperforming. And sometimes excluding the S&P companies can be a little trick you might want to think about. Or excluding the NASDAQs. All right, same thing. I'm going to leave the market cap at $1 billion, but you know how to create that. In this case, we are doing this slide number 15. Okay. I'm going to remove these things. And I'm going to go to profitability, I'm going to go to valuation ratios. And I'm going to go to common. Now, you're going to see here that all these arrows just show the menu that I'm working through. Valuation ratio, common, and I'm going to go to PB MRQ, most recent quarter, is what it means. Less than 1. And I'm going to find profitability of revenue greater than $1 billion, because that's always a useful thing. Revenues TTM greater than 1,000. And then the same thing, indicators industry. Now, like I said, one of the things I love about TradeStation is you can do this analysis and you can combine it with technical analysis. You can say, well, this is just kind of interesting. I mean, these companies match my criteria, but I want to see something else. I want to actually look at their price performance. You can just go right back in here, and then you can go to price. And there's a little thing I always do, price. You can go to percentage change, and then something like let's just go to something like a 4-week change, and then let's just say greater than minus 99. What that's going to do is it's going to allow us to sort now by their price change over different time frames. So you can now look for these companies who's up a lot or down a lot in the different time period, which can be a useful sort of thing to look at. It's interesting that right off the bat, we're getting a one of these Chinese companies that got really beaten lower and is now rebounding. So a lot of these companies I don't even know about. And honestly, I have not even run this all that recently. So let's actually inflate this. Well, I don't have time to mess with the chart, but you can look at some of these, like for example, Teladoc. It's interesting that this now trades at a less than price to book value. Now, this was one of those I didn't even know that. This is one of these Cathie Wood growth stocks. So we're starting to find some things here that are interesting. And we've had an aberration in this market. You know, you consider just I don't want to say an aberration, but we're at an extreme where we have companies that have basically gotten just taken apart, 80 and 90% down. And this is a time when doing some of this sort of analysis, I think, can be very interesting. But I wanted to highlight that because you can just go through and quickly see who's doing well, you know, who's struggling, things like that. And this is a valuation one. Okay, now, one of my favorites. I'll just mention also, if we're looking for value stocks, you can use this custom one, enterprise value divided by market cap, less than 1. Same thing, use the custom indicator I gave you. I'll just show you how to do that. Well, if you go here to, I'm going to just add it, go to indicator. And then it's EV. And we're going to say less than 1. Let's see how it works. It's going to go a little bit slower when you use a custom indicator. Not too bad. Let's see. There we go. So now we have a bunch of stocks that are trading for less than book value. But you know what? Honestly, this is correct. So basically, some of the custom indicators that I gave you exist in Scanner. In these buckets, in the folders of Scanner, they essentially do the same thing. They're just treated differently by the program. But so here we can actually look at these companies and see who trades at, you know, the kind of low price to book value. It's interesting. I mean, Foot Locker is one that I've been watching that it's very interesting. They've had some very interesting numbers. It's just gotten really hammered. This one keep coming up on my scans. Obviously, the chart is not pretty, but there are some interesting. The valuation on it is extremely low. This is one that might be interesting as we start getting into toward the holiday season. Anyway, let's look now for IPOs. This is where I think the real sort of interesting thing could be. So let's do another one. Let's call it recent IPOs. Create scan. 2020-07-07 recent IPOs. And then I'll get to your questions as this one is running. Same thing, we're going to go to all stocks. I'm going to leave industry in there just to save time. I'm going to look at companies with revenue of at least 500 million, but you don't have to. We're going to go to, profitability, revenue TTM greater than 500. All right, now the custom tool that I want to share. And it's called Ipo Tool. It has an exclamation point at the beginning. It has 2 outputs. You want to make sure you're looking at days of history. I'm going to say less than 400. Now, important thing to check. You have to make sure it's loading enough history. it should load at least 600. You can change this number here. What this thing does is it forces it to load. It says, I want to load 600 days of history. And if it can only find 300, it means that the company has only existed for 300 trading sessions, which means it's going to be a recent IPO. A company like Apple or something has, thousands of days of history going back. It's a really simple way to find these. So I'm going to go ahead and hit run. And as it's running, let's see what kind of question we got here. Will this be accessible later? Yes, this will be on YouTube in a couple of weeks. Okay, can I get a link to the recording? It will be on YouTube and I will post it on Market Insights. All right, I'm just looking here. See if there's any other questions. All right, looks like I have no other. In trading futures on the stock indexes, I find it easier to trade the overall market sentiment combined with technical analysis. What are your thoughts? I agree with that. And I have actually done a webinar when I essentially show that in my experience, the market goes through cycles of what I call kind of macro cycles and then stock picking cycles. So when the market's been hammered the way it is, we're in a period now where focusing on the big indexes is probably an easier way to go. When you get to that point, though, when the market rallies back, it doesn't even have to go to new highs. It just kind of goes back, rebounds decently. The fear starts to subside. The movement, and this is mainly volatility. Volatility subsides. You're going to have days when the S&P moves like 0.5%, third of a percent, and trading the indexes loses any kind of edge. And that's when switching to individual stocks makes sense. So I believe the market goes through modes of correlated volatility when you want the indexes, and then they go into periods of uncorrelated stock picking, and that can morph into complacency, which then can morph into volatility. So it's a cycle, and I've actually called it the volatility cycle. I agree with what you're saying. And I actually try to do this assessment for customers on TradingView and in my weekly S&P article that runs every Monday, or in this week it was on Tuesday. I always chart the S&P. If you go to that section, if you look back at some of those, most of the sort of levels and directions that I've been able to kind of, assess, they often kind of, play out. And I think it's really important because I don't think many people were expecting what we're seeing. From my perspective, I think this is going to catch some people by surprise, that they're going to look back and suddenly realize that, we might have just kind of ended this sort of deterioration. We're right now, I'm kind of watching to see. I mean, a lot of other things can happen right now. You always have to be kind of aware of this strange geopolitical situation we're in that can go in bad directions. But I think it's also important to realize that unless something really unexpected happens in Europe, the main focus for investors over the next month is going to likely be earnings, and then it's going to likely be a sense of the Fed kind of, essentially concluding their work. And in some way, that's how it's going to play out. It's too hard to predict at the next Fed meetings on the 27th, but we have things like earnings and other things along the way, non-farm payrolls tomorrow. So with everything happening in energy and everything else, even things like CPI numbers that might not reflect yet the crash we've had on energy prices, even those sort of things people might not necessarily take as seriously, because we've seen what's happened with commodity prices and these other signs of the economy slowing. Like I mentioned, things like the initial claims going up. All right, so what do we find? Right at the top of our list, Airbnb, Affirm. These are the big names you would expect. And here we go. And the nice thing about this is this allows you to look at how much history do they have, right? So you want to see recent IPOs and things like that. They're all right here. So this is some things that I'm going to be looking at, because I do these articles for people, and these are some of the techniques I use to start to find these sort of companies. And it's going to be interesting to kind of dig through some of these lists, some of these companies that you forget about, like ThoughtWorks, and a company like Toast, which was like a Square kind of company. Some of these other sort of companies on this list, that I'm just looking down at some of them now. Some of these technology companies. MQ was one I remember looking at, that was they do something with like web optimization. A lot of these are companies that have now fallen dramatically, and sifting through them could be interesting. So hopefully I've given you guys some sort of techniques you can use for going through here. I think it's important to always combine the big picture with like the smaller picture and to recognize that sort of shift in sentiment. And when that happens, fundamentals are a good thing to go to once you assess the condition that we're in. And if we go in this shift now away from value back to growth, that's going to mean people looking for companies that trade for higher price to book values, higher price to sales values, companies that have higher growth of book value over the 5-year period, things like that. That's another one to look at over time. 5-year revenue growth. Those numbers are going to be the numbers that people start to go back to and look at, or their models and their spreadsheets are programmed to look at and will start to pull up. So how do I incorporate TradingView into TradeStation? I don't have time for that now. If you actually go to some of these articles I've done, and in fact, I'll just briefly, really fast, go back here and look at my, if you go to Market Insights, go to this one here about Amazon chart of the day. This links to the Amazon article, but also if you follow this link here, it tells you what to do, how to set stuff up with TradingView. The information is there. So hope everyone has a great day. And please check out Market Insights. And I will be doing masterclass next week if you guys want to check that out too. Hope to see some of you there. Have a great day. Thank you much.